Good morning, everybody, and welcome to Saxo's Global Market Call. We have Friday the 19th of Jan. We will start, as usual, with a comment on FX from John Hardy.
Thanks, Christopher. Yeah, let's take a look at things. We've got, I think one of the biggest drivers, of course, of the weaker dollar we're seeing across the board is the Chinese yuan. We're seeing it aggressively stronger. It's a new low for the cycle. I think it's a key driver here. The question is why they're allowing the yuan to strengthen. There's a lot of speculation about that. Is this a diversification out of US Treasuries? Is that part of the driver of US yields lifting all along the curve? Because clearly we're seeing a decoupling of US yields, which have normally been, if they've been outstripping their peers and rising, you'd expect a stronger dollar, but this is not the case right now. So it demands an explanation. Not sure we have it, but one of those could be driven by China, but driven by fears of fiscal shortfall in the U.S., de-dollarization, what have you. So that's the clearest and starkest thing going on in the markets right now. Strong U.S. yields all along the curve now, with the 10-year, as I look at in the next slide, at a key level, the highest level since the shortly after the election of Donald Trump, and opening up potentially for the 3% for the 10-year benchmark. There's also all this fuss about the debt ceiling. I'm not sure that's really a driver. If that was really, people were really concerned about that, you would expect, I think, risk appetite to be off a little bit. Yeah, so dollar weakness is the theme. I think given this decoupling of rates and the dollar, you would expect maybe a market reassessment of dollar yen, especially from a positioning standpoint, as the markets look quite short of Japanese yen, whereas they're very long euros and other currencies versus the dollar. So I think there's potential for realizing most of the rest of this range in the short term if the dollar remains weak here. And we have a very busy week ahead, as we talk about here, or as we can see here. And a couple of interesting speakers. We've got the new rotation of the regional Fed presidents, which means we have new voters this year. So one of those, I think it's the Atlanta Fed's Bostic, is out speaking tonight. And I forgot to write the name here, but I think it's Quarles out even later. He's a new member on the Board of Governors. So interesting there. And then next week, it's very interesting as we have a Bank of Japan meeting Tuesday, Norges Bank and ECB on Thursday, and the first estimate of U.S. GDP on Friday. So this is the next big test for the euro. If it is strengthening beyond 123.25, whatever the exact high was, going into that Thursday meeting, and how much they're going to actually adjust policy higher. Though it feels to me like much of it is a weak dollar story as much as it is a strong euro story in this latter phase. Also next week we'll see Trump rubbing shoulders with global elites at the World Economic Forum. That should be quite a spectacle with many interesting media reports surrounding that. With that, I will pass you over to Peter on equities.
Thank you, John. So we're holding on to the gains here in equities. We had a mildly positive session in Asia. It's and basically the big retreat we had a couple of days ago has sort of disappeared. Earnings so far looks pretty good. Most of the majority of all the companies in the US have reported better than expectations on both the top line and the bottom line. We have European earnings season coming online on Monday and Tuesday and then onwards, and basically the next 2 weeks are going to be critical for the earnings season. As I've said repeatedly, our thesis is that we will continue to move higher due to the earnings season, and specifically over the next 2 weeks we will have the technology sector where we have the most momentum, particularly in technology, hardware, software, in semiconductors. So if they can beat expectation and we'll have a rosy outlook, then I think we could extend this rally in the short term. But then, as I said, we are already beginning to see some economic data disappointing a little bit against expectations, and I still suspect we'll get a correction in equities later this quarter. And then I've highlighted, as John, the US 10-year yield here, as you can see, highest levels in more than 3 years. We can see also the effect in equity markets, so the capital-intensive industries like real estate, utilities, telecom, etc. are taking a beating on this, and it's not only in the US. There's also a change in rate expectations in other areas, and rates are being hiked as well. Also in Canada, the ECB is changing their wording. We have the Bank of Japan changing their behavior in the market. So you can see this globally. And particularly, I would say real estate is where we see the most weakness. We're seeing weakness also among the ones that do construction of buildings. So you see that in Sweden and Canada, already. We had Carillion in London that are already now in restructuring. So it's not all rosy in equity markets. We do see some cracks. So watch those industries more carefully. And then IBM disappointed after the close yesterday in the US. They did manage to put out the first positive growth rate on the top line in more than 6 years. The reason why shares were down is that analysts were very, very disappointed on the growth rate in what they did sort of define as their new businesses, so the cloud, analytics businesses. Our quant model has a negative rating on IBM, so it's definitely not the place to be, according to our model. So that was sort of indicated on the results from IBM last night. And then looking forward, we have Slump as the first energy services company reporting today at 12 GMT. Very, very high and strong growth expectation, 65% jump in earnings per share and 14% jump in year-on-year growth on top line. So, and we know from the Q3 that Slump have really increasing and have a more positive outlook on the North American shale oil market. So that's definitely something we will watch today. And with that, I'll give the word to Ole on commodities. Thank you.
Thank you very much, Peter. That leads us well into the commodity space, because we have seen the market retreat this week. Yesterday, especially oil was lower, despite some quite bullish numbers from the US in terms of stocks. Just take a look at the table here. We saw quite a big. If you just ignore the API result, that's an error. But we saw quite a big reduction in crude oil stocks. And also distillates due to the cold currently hitting the US. But offsetting this was another weekly strong rise in the US crude oil production, once again getting very close to the 10 million barrel. And that happened on a day where the OPEC in their monthly report upgraded their outlook for non-OPEC production in 2018. So at this stage, the market is running into some technical selling pressure. The question is really. Once again, this underlying demand we have seen on a continuous basis for many months, whether that is going to kick back in again. But we just put out our first quarter outlook yesterday, and in that one we see the risk being skewed towards $60, down towards $60 on this record spec long, rising US production, and the potential risk to demand growth from the rise that we've seen in prices over the past 6 months. Before I just take a look at the chart over here, just go back to gold, because once again it's finding support. Following another, what I'll say, a weak correction, the dollar weakness has resumed, and the increased inflation focus is also limiting the impact on rising bond yields. Both Peter and John mentioned it, and if we just take a look here, we can see these are the nominal yields that John and Peter showed. But if you take the underlying break-even inflation rates, that's been picking up as well. That's basically leaving the break-even or the real yields, which is what gold investors are interested in, more or less unchanged. And we can see on the table here as well, since the low end on 12th December, it has not just been a question of dollar weakness. The dollar is down by 3.8% on indices, but we have gains of more than that in something like both yen and the Chinese yuan. So inflation and the dollar remains the key focus there. Support today 13.26 and 13.22, not 8, of course, 13.22. And again, we're returning to our outlook. We maintain a bullish outlook. I think the safe haven demand from the risk of investors being worried about elevated valuations in other markets will continue to attract some attention, and also the inflation focus that is continuing to remain a theme. Silver has underperformed due to this factor, because when the market is rallying on tail end risk protection and inflation, then silver tends to underperform, and we're seeing that at the moment. And that just basically leads us to our Q1 trade, which was in our outlook again, which was, as I mentioned, released yesterday. We are looking for a long gold, short WTI crude oil trade. You can see the oil has been outperforming for a long time. If you go even further back, we're coming from even higher levels. We reached a low around 2060, and we could see that potentially move higher over the coming months. That's it for me. Have a great weekend when you get there.
Thank you, Ole, and that's it for us today. We wish you all a nice weekend, and we'll return on Monday at 8:40 CT.